Hello, everyone. My name is Garrett Watson. I'm the Special Projects Manager here at the Tax Foundation. I'd like to thank all of you for coming out to attend today's Talking Tax panel event. I work on federal and state tax policy at the Tax Foundation, focusing on how to improve the tax code for entrepreneurs, innovators, and how to improve and increase innovation and dynamism in the American economy. And the topic of today's panel will be how to improve the federal tax code for gig economy workers. Before I start off, I'd like to thank our panelists for their participation today, to the Senate Finance Committee, our sponsor, H&R Block, as well as all of you for attending. And in terms of the setup of the panel, I'm going to introduce our panelists. I'll give about 5 minutes to provide a motivation for why this topic matters, why should we hear about improving the federal tax code for gig economy workers, and then we'll turn it over to each of our panelists to provide about 10 minutes of opening remarks on their perspective and views on this important subject. I'll have a few follow-up questions to encourage conversation. We'll make sure to leave some time at the end of our event to take any questions you may have for each of our panelists. So before I provide some remarks on the motivation for why we should care about this issue, I'd like to introduce our panelists and give you a sense of their background. Directly to my right is Andy Phillips, who is director with the Tax Institute at H&R Block. Andy leads the company's regulatory engagement strategy. In addition, Andy leads a team of centralized tax professionals who serve clients virtually through an online platform created by H&R Block. Prior to focusing upon Block's regulatory engagement strategy, Andy was responsible for H&R Block's tax research operations, and his team has provided tax law research and supports their network's 10,000 retail tax offices, and provides advice directly to clients utilizing H&R Block's platform of do-it-yourself tax products. Andy received his undergraduate degree from Avila University and both his JD and LLM from the University of Missouri Kansas City School of Law. To his right is Caroline Bruckner, who is a tax professor on the faculty of American University's Kogod School of Business and is the managing director of the Kogod Tax Policy Center. In this capacity, she has testified both to the U.S. House and Senate congressional committees as well as the IRS, and has released groundbreaking research on the tax compliance challenges of the small business owners powering the sharing economy, as well as how the U.S. tax code impacts women business owners. She previously worked for the U.S. Senate Committee on Small Business and Entrepreneurship from 2009 to 2014, ultimately as chief counsel, where she developed small business tax legislation and advised the committee in its chair on tax, labor, and budget matters. Professor Bruckner has an LLM in taxation from Georgetown University Law Center, a JD from George Mason University School of Law, and a BA in political science from Emory University. And to her right is Shelley Stewart, who is the research manager for the Future of Work initiative at the Aspen Institute, and is an economic sociologist focusing on the changing nature of work in American society. An expert in labor, culture, and public policy, she holds a PhD in sociology from the University of California, Berkeley. Her research examines how people understand their position in the labor market and the economy more broadly. Her dissertation examined experiences of precarious and insecure work in the oil and tech industries. She's been a National Science Foundation Graduate Fellow, a Kinder Scholar at Rice University, and an Assessment and Evaluation Fellow at UC Berkeley. She also holds an A.B. from Harvard College. So with the biographies of each of our panelists out of the way, I'd like to provide a few minutes of overview of why we should care about the issues of improving the tax code for gig economy workers. As most of us are aware, and most of us have used services that have been provided by gig economy workers at one point or another. This has been facilitated by the rise of smartphone technology that gives workers the opportunity to use spare assets, be it an unused car or a spare room, for extra income, also enabling them to have flexible scheduling and set their own hours for when they would like to work in the gig economy. The barriers to entry in this kind of work have fallen as a result because these workers do not need to raise the capital, set a marketing strategy, find a customer base, or deal with all the other related compliance challenges related to starting your own small business and doing similar work. The result of this has meant that gig economy work has risen dramatically over the past decade, and approximately 4.5% of American families participate in gig economy work at one point or another, according to one estimate, up from 1% in 2014. Now, how does this all matter for tax policy? Well, the dramatic rise in gig economy work has implications for the tax system, as the tax system treats these workers the same as the broader group of independent contractors and freelancers. These workers who previously and mostly relied on the employment relationship to determine how they deal with their taxes, the employer withholding of income and payroll taxes. Instead, in an independent contracting relationship, for example, these workers are expected to calculate, save, and remit their income and self-employment taxes themselves. These gig economy workers, because there's a big education gap in terms of how to do this properly, are less likely to report properly their income tax and self-employment tax. There's also a dramatic increase in compliance costs and complexity for these workers, as they're also expected to properly track and deduct their expenses from their gross income, which is a large challenge for them. They may either accidentally overpay tax because they do not take expenses that they were otherwise eligible for, or they may underpay tax if they take expenses that they were not supposed to take. These taxpayers are must determine themselves the expenses that they're allowed to take and divide those expenses between business and personal use for assets they're using for both of those purposes. Take a car, for example, the ride sharing that we're all familiar with. If a worker has a car they're using for personal and business use, they must apportion the expenses they have for that asset between their personal use and the deductible expense for business use. And this leads to significant complexity for them and an area of potential error. And the final thing I'll mention to motivate this panel is that there are opportunities to potentially simplify the tax code for these workers, as well as improving the reporting process to facilitate information flow for both taxpayers and for the Internal Revenue Service. This may also have ramification for the broader cohort of independent contractors and freelancers who still make up a large and growing segment of our labor force today. So with all that in mind, I'd like to turn it over now to our first panelist, Andy Phillips, who has a unique perspective on the taxpayer filing and preparation process.
Thank you, Garrett. And so thank you for having me today, and thank you to the Tax Foundation for hosting, and to the other panelists for joining. I'm incredibly excited to hear what everyone has to say. And so as Garrett mentioned, my name is Andy Phillips, and I work with H&R Block. And so H&R Block in a given year helps, roughly 20 million or a little over U.S. taxpayers with filing their taxes between all of our tax offices and our DIY programs. That's about 1 in 7 taxpayers, and these are generally all individual and small business taxpayers. So what this does is this gives us direct line of sight into how changes in tax law, tax policy, or in this case, how taxpayers work and earn income impacts them at tax time. And so it's a direct line of what trends and things, how as those things change, it changes their tax complexity and their ability to comply with their obligations. So I'll lean a bit closer here. One thing I kind of want to tee up here is that taxpayers that come to H&R Block, what they're looking to do is comply with their tax obligations. And so what I want to do is give you a picture of, I'm not going to touch too much on where there's opportunities to not comply, but instead focus specifically on the challenges that those that are trying to comply face. And so with that, what I kind of want to do with my remaining time is, one, just talk a little bit about a few segments of the gig economy and some of the specific challenges they face. And then what I'll kind of wrap up with is conclude with an example tying this all together to give you a real world perspective of what H&R Block sees when gig workers come in to file their taxes. And so before I dive in, I liked how Garrett kind of teed up, with smartphones and apps, the ability to and the gig space, the ability to become a small business owner, the barriers have almost evaporated, right? It's much easier than it used to be, especially that ability to use your existing assets and have a ready-to-serve client base served up on a platter for you. What does that mean for taxes? Well, for a lot, and the other thing is, in a lot of these cases, which I'll unpack more in a few minutes, it doesn't require any special skills. A lot of things are the basic things you would think about for tasks. And so a lot of these folks come into being self-employed without understanding the attendant tax obligations that they've assumed. And so with that, let's go ahead and dive into the first type of worker, which is, a driver. You think Uber or Lyft, and some of the challenges they face. So I think Garrett talked quite a bit about expense tracking, so I won't rehash what he said there. What I will say is one of the requirements to be able to deduct your expenses is that you keep track of those expenses real time, or what's called contemporaneously. And many taxpayers don't do that, especially in that first year they work in the gig economy. Fortunately, some of the platforms in this space do help them track some of those expenses like mileage, but not all of them. So many times taxpayers come in to file that first tax return, and we're trying to reconstruct records based upon what they have from receipts and their what the platform they've worked for can provide to them. And so I'll leave that there for now. The next one is actually tracking income. And so most platforms issue what's called a 1099K, and they use the associated threshold for when they would be required to issue one. The kind of contrary to that would be that otherwise they would issue a 1099 miss, which they would issue that form if the taxpayer was paid at least $600 or more for their services during the year. Whereas the 1099K is not required to be issued at the federal level unless the taxpayer has over $20,000 in gross income in over 200 transactions. While some platforms choose to voluntarily go ahead and issue a 1099K to their workers, not all do, and that leaves taxpayers left to kind of reconstruct their income based upon their account statements and the like. For drivers, it's usually okay because they usually don't work for more than a couple platforms, but as I'll go through an example, many folks in this space may work for several platforms, and that's when it gets a lot more difficult to track all of that income. And some bills have been introduced to address this at the federal level. I'll leave that for others. States have come in and more are coming in with lower thresholds on when a 1099K is required. Different thresholds, which I think is one challenge. But really, what H&R Block finds is many taxpayers come in without a formal income reporting document. And so we talk about the challenges that creates, and then of course it creates opportunities for underreporting. And so the last thing I'll talk about with the driver is calculating and remitting income taxes and self-employment taxes, which many may be required to do during the year. So I think Garrett kind of touched on well, but many taxpayers that have moved into the gig economy have not been self-employed before. They've worked as a W-2 employee, and they're used to their employer withholding their payroll, Social Security, and Medicare, and federal and state income tax obligations. So when they move into the gig economy, it's not something they're used to doing to make tax payments during the year. If they expect to owe more than $1,000, they're actually required to make estimated payments. There can be small penalties for failing to do that, but the bigger issue here is when they go to file that tax return and they've been living the whole year like they've been clearing, whatever their take-home pay is, thinking that's what their actual take-home pay is. And then they come in to file their return, even if they're lower, on the lower income side with the expanded standard deduction for tax reform and, the 199A deduction, they may not have a tax liability for income tax, but they still owe SE tax. For any taxpayer, if they have an unexpected bill or several hundred or even a few $1,000s, it's a big deal. For low to moderate income taxpayers, it can be life altering. So let's move to the next group, which is the next group or kind of cohort or segment of the gig economy I want to talk about are those that rent out property like a spare room or a vacation home through Airbnb. And so for those taxpayers, once again, they have different requirements for tracking expenses. They have to do several allocations. Oftentimes they're renting property that's both personal and business use. So they have to allocate between their personal and business use and understand what's deductible and what's not. They have to figure out if the income's even reportable. No matter how much they earned, if they rented for less than 15 days a year, it's not even taxable. They don't have to report it. We're not really worried about those folks today. That's great for them. But I will say they have to figure out what form they have to file. Is it Schedule E because they're a typical landlord? Fine, they just pay income tax on that income. If they're providing substantial services as a landlord, that generally is treated as a business, which means they're generally reporting on Schedule C, which creates then not just income tax, but self-employment tax obligations, which is a surprise to many when they come to file that tax return with H&R Block. And so, we're talking mostly about income tax, but these folks also have to worry about other tax obligations like local occupancy or lodging taxes and making sure they're complying with those obligations as well. Some platforms do help them with that, but ultimately that's generally going to be their responsibility. And so the last piece I'll just talk about is those that work in the service economy for like TaskRabbit or things like that. And in this group, I'd say they generally, they may do something as simple as walking a dog, or they may do repairs and maintenance. These folks generally, run into the same challenges that I've highlighted above. But one of the unique challenges for them, particularly if they're doing like a construction trade, is they may have a W-2 job doing the same thing, and then they do this on the weekends, nights and weekends. So they have to do the complex allocation of what are my W-2 employee expenses, and then what are my actual, small business expenses. So for sake of time, we'll go ahead and leave that there, because I think that touches most of what they deal with. And so let's talk about someone, and I'm going to kind of read this for time and to make sure I hit it all. So let's talk about a typical taxpayer and how this works, and a lot of times what we see with H&R Block for those that work full-time in this space. So we're going to start with a taxpayer named Rick, who's left his W-2 job and moved into the gig economy. During the day, Rick is a driver. He drives for Uber, Lyft, and Grubhub. On weekends at night, through we'll say TaskRabbit or Handy, he does random services like literally you can hire someone to wait in line for you on Black Friday. So he does a variety of things like that. So he's got that separate business where he's got to track his income and expenses for both those. And then Rick may have a spare room in his home. He lives in a popular area. So Rick is actually, a landlord as well through Airbnb, because several weekends a year, he rents out that spare room for people that are coming to, we'll say DC, for different tourist events. So he's also a landlord. So he's got a complex life, right? So it's his first year doing this. He's not made payments during the year, and he thinks that those checks he's getting, which net some expenses, but really aren't accounting for taxes, are what he's clearing. That means he's spending that money like that is his take-home pay without thinking about the tax obligations. So Rick comes to file his tax return. First, he's got all the driver services, right? Those are substantially similar services. So we'll say he gets to report all of that on one Schedule C. The tasks he's doing, the repairs and things like that, do not fall within the substantially similar services to what he was doing as a driver. So he's got a second Schedule C. He's got to make sure he's not duplicating expenses between the two jobs he has there. And he's got to then do the same income tracking and expense tracking that he does, for his driver job. And then last, he has to complete a Schedule E. He doesn't provide substantial services for those people renting a room. So he's got to complete a Schedule E and do complex calculations. Because he only rents a portion of the year, he's got to break down by day how much personal and rental use he has for certain expenses. And then because he only rents a portion of his home, he has to do a second calculation to figure out, based on generally square footage, how much of those expenses he gets to take based upon how much of his home is business use, right? So if you guys are getting confused, think about our guy Rick. At this point, he's like, okay, what did I just get myself into? And I'm hitting the high notes here. We haven't talked about that Rick has a nephew living with him that he's trying to figure out, can I claim him for the child tax credit or the other dependent credit? We haven't talked about whether he's going to itemize or claim the standard deduction. We've not talked about that he took an early IRA distribution because he had a beater. He's like, I need to get a new car to be able to drive for Uber. And the tax implications there, and I'm not even going to touch on 199A. That is a panel in itself, and it's multiple panels. So he finishes his return. He hasn't been making payments during the year. He may be left between his income tax and self-employment tax obligations owing several $1,000s. And he was, as I said, he was living like he was clearing that money. This is why this matters. This is part of why we're here to talk about this today, because Rick may at that point say, oftentimes when we have people that are hit in the face like this in a tax office, they get up and walk out. They get up and walk out because they're very nervous. Those folks, they may fall out of the tax system. They may go somewhere else and figure out how they can play with their expenses to reduce their bill. They may fall out of the tax filing system altogether. And then the last piece I'll say there is, of course, he may decide he's not going to work in the gig economy anymore. So I'll leave for later questions some potential ideas that we see for potential ways to help these taxpayers comply. And now that Garrett and I have attempted to put a little color on why this really matters and how it lands in the laps of the average American, I'll pass it over to Carolyn.
Well, thanks. So thank you so much for hosting this event, and thank you so much for including me. I have been thinking about these issues and trying to figure out a way to help these taxpayers since I transitioned from working in the Senate to working in academia in 2015. When I joined the faculty of COGOD, I became the managing director of the COGOD Tax Policy Center, which focuses on tax research and compliance issues that are specific to small businesses and entrepreneurs. And what I really care about are the smallest of small business owners, the self-employed. And when I transitioned to COGOD, I was really interested at the time at looking at gig economy work, because the idea was I was going to invent brand new tax policy to help these taxpayers pay their taxes and ease their tax compliance burdens, because for 6 years while working in the Senate, I had heard nonstop on the Senate Small Business Committee how hard it was for the smallest of small business owners to comply, as you just heard an example of, with their tax code obligations. So in putting together my initial research, I partnered with the National Association of the Self-Employed, a group that I had worked with regularly while I was on the Senate Small Business Committee, and I devised a scheme whereby they would administer a survey on the tax compliance challenges of their members who are experienced self-employed taxpayers, as represented by the fact that they're members in the National Association of the Self-Employed, who, if anyone, should know how to comply with their tax compliance challenges or their tax obligations as a self-employed worker. It should be these people. And I devised a survey of this population to try to figure out how many people in their membership were actually doing gig economy work and what their tax pain points were. And in putting together this survey, I partnered with a guy named Jim White, who was head of tax research for GAO and has put out dozens, while he was head of GAO's tax research division, he put out dozens of GAO reports on misreporting, underreporting, tax gap challenges, and who is a nationally recognized expert on these issues. It just so happened that when I started at COGOT that same month, he retired. And I had reached out to Jim because he had testified before the Senate Small Business Committee when I was a staffer there. And I begged him to partner with me on this research, having never done a survey ever in my life. However, Jim had done plenty and was an economist. And we worked together with NACE to develop this survey. Our hope was just to ask basic tax compliance pain points questions and then move on quickly to see what kinds of innovative tax policy ideas we could develop to help these taxpayers. And when we got the survey results, we were literally stunned because if this population of taxpayers had such challenges and pain points in trying to comply with their tax obligations, then the results translated much more significantly across the broader US tax-paying space, right? If these people who are experienced self-employed small business owners don't know how to pay their taxes, don't know what credits, deductions, exemptions, what have you, would have applied to lower their tax liability, don't know that they need to pay quarterly estimated payments when they're expected to owe more than $1,000 worth of taxes, which, by the way, it's usually not income taxes that triggers your quarterly estimated payments. It's your self-employment taxes, which are the Social Security and Medicare taxes that you pay as a self-employed worker. If they don't know that, that's really telling that the broader American taxpayer population engaging in this kind of work has absolutely no idea. And what was most telling about the research that we did was that it, for the first time, illustrated the problem of having two different thresholds for giving taxpayers 1099s. On the one hand, with a 1099 miscellaneous, that's when payers for goods and services are required to furnish a 1099 miscellaneous to service providers and sellers when they have $600 worth of payments. But for platforms who are considered, for tax law purposes, third-party settlement organizations, meaning that they connect service providers and sellers with customers, and this is key, process payment, they're not required to give any kind of 1099 until there's $20,000 and more than 200 transactions. And the reality is, what we know about people that work in the gig economy is that the majority of people that do this kind of work come nowhere close to earning $20,000. And oftentimes, if you're doing the asset rental space, you don't have 200 transactions. So to give you just some anecdotal evidence, I ran a gig economy tax conference in San Francisco last month. I stayed at an Airbnb. The host earned $40,000 renting out their basement got no 1099 whatsoever on $40,000 worth of income. Now, the host was in compliance with her tax obligations. She had registered consistent with San Francisco regulations on how to do an Airbnb, and so had a certificate of business ownership, which is required for displaying in Airbnbs in San Francisco. But the point is, she got no 1099, and what that means is that the IRS didn't either. So that was the information that I learned from my initial research on this point, which made me stop and pause and recognize that before I could develop innovative new tax policy for these taxpayers to help ease their tax-paying burdens, I had to get them tax forms first, right, as an initial preliminary matter. And why does that matter? Well, it matters because when these workers don't get tax forms, our tax gap data shows that these workers are likely to misreport, meaning either underreport or not report at all, the income that they earn in this space. And you just heard from Andy over here that many times you have taxpayers that find out that they owe a whopping self-employment tax bill or income tax bill and get overwhelmed and just walk away from paying their taxes altogether. I've heard that multiple times from even IRS folks that I've interviewed that have been doing work in this space. Now, the tax gap data that I've looked at, it shows that when there is no information reporting, meaning no 1099 or withholding in place, there are some studies that show that there's a 63% chance that folks are not going to properly report their income. Private sector survey data is pretty consistent with that. There is some private sector survey data that was issued in 2018. It was an Intuit survey data of self-employed small business owners that showed 32% of self-employed workers underreport their income and 36% just didn't report it at all. And so when we have both IRS data and independent private sector survey data showing that there's massive misreporting, we know that it contributes to the tax gap. But my next area of research, which was released earlier this year, was a paper funded by Boston College Center for Retirement Research, actually tried to quantify what this means with respect to not income taxes, but Social Security taxes. Because it is Social Security that really trips up these taxpayers because, number one, that's what triggers usually their quarterly estimated payment obligations. And number two, you don't have to pay self-employment tax until you earn at least $400 worth of income. So you might not owe $1,000 in taxes triggering a quarterly estimated payment. But if you're doing work in a gig economy platform, you're likely going to earn at least $400 before you cycle in and out. Now, keep in mind, most gig economy platform workers do this work on the side, and they do it as a supplemental source of income. It's about 20% of their overall income picture. They don't do this as their sole source of income, although there is a strong percentage that ranges from like 1/3 to a little bit more of people that do this full time. The majority of people that do this work do it as a supplemental source of income, and they do it on the side, and they cycle in and out of the gig economy, and they don't necessarily remember or retain how much they earned or certainly track your expenses, as was illustrated earlier. This has really important implications for not only the tax gap generally, but more specifically, Social Security, because the majority of people that are doing this kind of work might not have access to retirement planning strategies other than Social Security. And if they're not paying into Social Security on the front end, they're not getting credited to their Social Security accounts, so that on the back end, when they retire, they're doing themselves their own disservice by not getting credited for the income that they earn and pay taxes on through self-employment taxes on this income that they earn. And so that is my latest research, which actually put together estimates on how much and how big we think this problem is. I looked at a bunch of different data sets. I looked at the best data set for specifically platform work is the JP Morgan Chase Institute's data on that finds that there are about 2.3 million people that do this work every month. And then in addition, I looked at a census product, which is the survey of income and program participation, to try to get a general sense for how much underreporting would impact Social Security in any one given year. And it's about, $1 billion, $1.5 billion of just platform workers, and I'm not talking about the universe of independent contract workers. I'm talking about just platform workers in any given year. But when I told Jim White, I put together my estimates this way and the population that I looked at, he immediately said, "You're being too conservative. It's much worse than that." And he's absolutely right. My numbers are absolutely conservative, back of the envelope estimates, because the problem is actually my data sets were actually from 2014 and earlier, and the problem is actually much more pervasive and growing. My new research, which will be coming out later next year, which has been funded by Wharton School of Business, will be looking at how this is also a gendered problem, because even though the gig economy, thus far the growth has been primarily powered by the ride sharing and transportation sector, there's a fast growing latent other services sector of women in particular that are doing care work, because you also have to keep in mind the demographics of our aging population. We have 10,000 baby boomers retiring every day, and many of those workers, particularly women, are having to turn to the gig economy to supplement their retirement savings, because women over time don't have the same opportunity to pay into Social Security because they take time out of the workforce to care for family A, but at the same time they live longer and have higher healthcare costs. So that will be the next area of my research, and I think I'll cut it off from there. And forgot to check my time because I can talk for quite a bit on this issue, if you haven't noticed.
Great, thank you, Carolyn, and thank you to Andy as well and Garrett and the Tax Foundation for hosting this event. So as we've heard from sort of all of the other panelists, this is a problem. It's a problem for the individual taxpayers who don't know how to file their taxes, and it's a problem for the nation because there's a lot of lost revenue happening. So I'm going to center my comments around what we can do about it and sort of lay out a few policy ideas that have been proposed, some by the Future of Work Initiative at Aspen Institute, as well as a few others to sort of open the discussion about looking forward and where to go. So before getting to the concrete policy ideas, reiterating a couple things that have been said, platform workers are a relatively small percentage of the workforce. In a given month, it's about 1%. It gets higher if you look over a longer period of time because people cycle in and out of this work. So if you look at a month, it's about 1%, which isn't a huge number, but it's also not completely insignificant. You know, you add those together and it's a sizable number of folks. And most of these are supplemental earners, as Carolyn said. So they're not full-time, only gig economy people. They have another source of income. It might be a W-2 job. They may not be the primary income earner for their household, but they're doing it on the side and often sporadically. So over the course of a year, maybe they'll work in December to earn some extra money for the holidays, then stop for a while, and then work again in June when their car breaks down and they need to pay the bill. So it's not a typical work pattern, which comes into play for taxes because it's not front of people's minds as a source of income that they would need to pay taxes on. And then the other sort of contextual thing to keep in mind is the heterogeneity of what we're calling gig economy jobs. These jobs that are arranged on online platforms. The most often referenced ones are ride sharing, Uber and Lyft driving. A lot of people think of delivery as well. We've talked about Airbnb. There's dog walking. There is services that just connect for any type of labor or services to be done, whether that's graphic design or web design or standing in line for Black Friday. And so in this universe, there's a lot of differences. And when we start thinking about policy solutions, some of those differences come into play. And with that, one of the adjacent policy issues that is being addressed at the state level and getting increasing focus at the national level is the issue of worker classification. A lot of these complications are coming up rooted in the fact that these gig economy workers are classified as independent contractors rather than being classified as employees, an arrangement which would give them W-2s and employee or employer withholding of the taxes and sort of not have these same sets of issues. So that's an important factor in any gig economy policy, But it doesn't mean that we shouldn't also be having these conversations about taxes. Whatever decision might be made on classification for a particular gig arrangement, we still have this new way of arranging work that has a lot of tax complications that our current tax code doesn't have a way to address. So as much as policymakers need to think about classification, it's a both and question when it comes to the tax policies. And so with that, I'll sort of go through a series of policy ideas, starting with the lowest hanging fruit, what might be most feasible in a shorter time frame, and work towards some more revolutionary approaches to how we can simplify things for gig economy workers. So at the top would be clarifying what this third-party settlement organization really is. This came up with the introduction of the Form 1099-K in 2009, which is before the advent and the explosion of platform work. And so there is a definition in the tax code, but it doesn't specifically reference how gig economy platforms would fit into this. They sort of entered as these third-party settlement organizations, and that's how things have played out. But IRS can revisit that and think about, where do these platforms really fit? And with that is the differentiation between goods platforms and service platforms. Is money being made through selling something versus performing labor? And should these be considered different types of transactions for the tax code? So some of those clarifications to just revisit, given all of the ways that technology have developed. Another possibility is to mandate that the gig economy companies provide more information to their workers, both about their income and also about their tax obligations and expense tracking requirements and possibilities. As Carolyn was mentioning, a lot of these workers don't even know what they can claim as expenses, and that information could be provided by companies. With a nudge by government, that could make a big difference in just levels of understanding. There's also the possibility to expand volunteer income tax assistance programs to offer training to volunteers specifically on these issues and expand the program so that there are more folks available for assistance. And I would group those together as the lower hanging fruit when it comes to policies. The bigger steps that could be taken, the first is to lower and standardize the reporting threshold. And this is what's come up before, this difference between the $600 threshold for 1099 MISC forms and the $20,000 200 transaction threshold for 1099K forms. Massachusetts and Vermont have already done this at the state level in 2017, so that regardless of the type of 1099 that's issued, if it's above $600, the recipient gets the form, and the state IRS then also knows about that income. So it's too early on to have a lot of evaluation of what the impact has been on revenue, but other states can consider that, and depending on its level of success, it's something that the federal government may consider. The Future of Work Initiative did some economic modeling through District Economics Group looking at this, and at the very most conservative end, the estimate was between 112 and 250 million in annual revenue if this reporting threshold was lowered, the 1099K threshold. The other key piece of this puzzle would be to have some type of withholding offered to these workers. As Carolyn was saying, reporting plus withholding results in pretty accurate tax filing. You have neither of those, and you have a lot of income being unreported. So to offer withholding with enough to make it optional for workers, because there's such a range of types of work and there's a range of percentage of gross pay that's going to expenses. So there are folks who may be spending 90% of the money that they are bringing in. They need that money immediately to cover their expenses for their self-employment, whereas other types of self-employment work has a much different expense ratio, so that much more of that could be withheld because much more of it would be owed in taxes. So Future of Work Initiative put together a proposal with sort of suggested optional rates of withholding, with also the option of opting out for workers. However, offering that would be mandatory for companies so long as they had more than 100 contractors in a given year. So those are sort of the biggest steps to really simplify things and make the situation for gig economy workers as comparable to W-2 employees as possible. We've also looked at a standardized deduction for gig economy workers, which has a lot of details to work out. And as we went through the possibilities, it's difficult to imagine a standardized deduction for them that would actually simplify things because in order to make it equitable, you need to look at the differences between industries. Since expense ratios are so different, by the time you separate it out into as many industries as exist within the gig economy, you end up with a situation that is not actually that simple. So I'd sort of lay that out as the realm of potential policy solutions and welcome additional questions on those or other ideas.
Thanks to each of our panelists for their opening remarks. I have a few follow-up questions for any and all of you before turning it over to the audience for questions. The one thing we've heard, I think, from each of you is the importance of filling the education gap, right? And there have been efforts to increase educational resources. For example, the IRS opened the Sharing Economy Tax Center to help these gig economy workers to fill in the gaps there. Platforms have been doing some thinking about how to help educational efforts there. How should we think about those efforts for education? What is the relative role of those efforts versus policy change when we think about actually tackling and improving the problems we see here?
It's a great question, and the first thing I'd say on that is we have to take a realization of how taxpayers really consume help content and where they go to get that help content. I personally love IRS's help content, love the FAQs, and when the FAQs and Rev Rule just came out on virtual currency, I dropped everything to go read it, right? I'm a tax nerd. The average guy doesn't do that, average guy or gal doesn't do that. And so I think it's really a really good example is with tax reform. The IRS was steady beating the drum. They had an incredibly involved campaign just to get taxpayers to do a paycheck checkup because of changes to the withholding tables. We, H&R Block, did a study before this past tax season, and we found that less than 1 in 5 taxpayers had made any changes to their W-4. And frankly, most of them didn't even know what it was. Some said, yes, I changed my health insurance with my employer. That's not how taxpayers consume help content in a lot of cases, particularly those that aren't working with a CPA or an advisor. So I think working with the platforms, H&R Block in the past has worked with some of the larger platforms and will continue to try to do so to help taxpayers with that short, brief, kind of user-friendly help content. But the last piece I'll touch on is just timing. As the example that I talked through Illuminated, you've got to get them when they first come into the gig economy system. And we talked a lot about the part-timers. A lot of these folks are working part-time because of the self-employment tax. Even if you only make $5,000 or $6,000 or less, and you have a W-2 job, just the SE tax alone creates meaningful tax obligations that can create economic hardship. So I think the timing of getting in front of these folks as soon as possible is incredibly important. And I think the other piece is a couple of the policy ideas that Shelley talked about will help address the subset of taxpayers that are just never going to consume that content themselves.
So I think education is important. And any kind of education effort has to be accessible through a smartphone because this is how these people do work, right? And if you're going to give people an opportunity and information about their tax obligations, you have to give it to them in a form in which they will consume it. And so whatever you do, it has to be accessible through a smartphone. But at the same time, I would say education is not a substitute for a tax form. There's lots of data out there that education might not be that successful in resolving this issue, and there's at least one JCT score out there that says that if you lower the 20,200 transaction threshold, it raises about $3 billion. And I think that score from JCT is actually quite low because I don't think they're measuring the full population of people that are doing this work. And I think that that's pretty telling in and of itself. And I just can't, I think that education is a great start and should accompany anything. And also the IRS, the new tax, they've just issued a new quarterly estimated payments calculator for this population that is quite helpful, but it's just not going to be a substitute for tax forms and aligning those thresholds.
Can I just echo what Carolyn just said, to see the education piece and the policy change piece as coinciding needs. The education needs to happen today or 5 years ago, and the simplification of the process so that this modern way of working is simplified needs to happen as quickly as possible, understanding that's going to be a bit slower than posting some websites or expanding some volunteer assistance.
What are some of the information gaps or questions that we don't have enough data to address that you'd like to see filled in future research, either in academia or by folks participating in the space?
Okay, so there are so many information gaps in terms of where we're going with gig economy work, because so much of this conversation has been literally driven by ride sharing. And Uber and Lyft have dominated these conversations because ride sharing is predominantly responsible for the majority of the growth. But when we think about trends of how global trends and how we're going to be working in the future of work is it's changing, and more and more, and you can certainly, your research certainly touches on this more than I do, but I'm certainly very interested in the gendered breakdown in the future other sectors of gig economy work driven by our demographics. I want to look at how is care work going to take advantage of gig economy arrangements. Anyone who has a parent or a grandparent who is not yet in assisted living, but you're trying to keep in their home, you have round-the-clock care work. And a lot of people are doing gig economy care work to make ends meet. That is going to become more and more commonplace with our changing demographics. And so I also think that there's a gendered issue there too, because I think women are going to be doing more of that, which is where my research is going to be looking going forward, but I'm sure you
Yeah, so I think there is a lot of knowledge gaps here, and they've come up just in our comments, sort of the range of estimates of how many people are doing this work, and sort of more importantly to this conversation, how much they're making. We have a set of standard tools and measurements for work that was developed generations ago that measures pretty accurately a traditional form of full-time permanent employment and doesn't necessarily capture the ways that a lot of people need to work today, which involves piecing together a lot of different types of employments, working on the side for a few hours here and there every couple of months. That's the economic reality today. That's what the labor market looks like, but we're not sure how to measure it. We know that some people would count that side hustle a job, other people wouldn't. So if they're asked if they have multiple jobs, you have people doing the same types of work. Some will say yes, some will say no. So we have a lot of missing knowledge just on how many people are doing this type of work and how much they're making. And if we're looking at how much revenue we're potentially losing as a result of the complex tax process, we just don't really know, because the estimates could be based on, is it the number of folks participating? Is it the hours that they're participating? Is it their gross receipts that are brought in? Depending on what we look at, the numbers end up being skewed pretty drastically one way or the other.
So I think the others have some really interesting things to say. I'll put a little different twist on that, which is, at H&R Block, what we try to do is look at different types of taxpayers and figure out specific ways we can help them. And what proves very difficult to be able to identify gig economy workers and then look for patterns and trends beyond the anecdotal or surveys from tax pro focus groups or just taxpayers is there's three big things. One is, what is the definition of the gig economy? There's so many different aspects to it, right? Here's the next piece, is how do you identify, based on their tax returns, the taxpayers work in the gig economy? Well, the first way is you look at the business code. For taxpayers that are filing a Schedule C as a sole proprietor, you would look at the business code on their Schedule C to determine what space they're working in. Two challenges there. One, there's an other, and like everything else in life, taxpayers, especially DIY, choose other. So you can't use it, right? It's a bucket of all kinds of different stuff. And then the second piece is, well, for those that get 1099s, we can go by EIN and figure out, okay, let's look at those taxpayers and see if we can find trends and ways we might be able to help them. And because many of them don't receive a 1099, it's very hard to identify, even within our clients or our data set, who are the gig economy workers and what can we do to help them. And so, again, we sometimes are stuck with anecdotal or surveys and things like that, because it's very hard to get to that hard data, even from the tax returns.
As we've heard with several of your responses, especially in the reporting side and other aspects of this work, the gig economy platforms play a large role in facilitating the administration of some of this information. What role should platforms play in this process when we think about foreign opportunities? How should they think about their role in space to improve the tax experience of these workers?
Well, at a minimum, they should be required to give workers a 1099. I mean, that's just it's not a heavy lift. It's not hard. Many of the major players in this space have, over the course of their existence, at one time or another, given 1099s to workers. Airbnb goes so far as to collect state and hotel occupancy taxes for some of their hosts in different jurisdictions. If you can collect and remit taxes to state tax authorities, then surely you can give a 1099. But I think when I've talked to the platforms, and the last time I was on a panel with a platform, their position was, we just all want to be treated the same, right? Like if we all have to give 1099s, fine, but don't treat one industry or one sector different than another. And if that's the case, fine, then make everyone give a 1099. And you could even go so far as to mandate that it be electronic and not even mailed, and save them on the postage, right? But at a minimum, let's get taxpayers the forms they need to at least be prompted to properly report this income.
And I definitely agree with the reporting of the income at the end of the year, but also when someone begins working, signs up with these platforms, enough education available to them. They may or may not read it, but in some way, as accessible as possible, what their tax year is going to look like, what documenting expenses should look like, how much should be set aside. There are various sort of third-party smartphone-based tools to have things like withholding accounts that the worker still holds, but they have that money going into a separate account. Right now they exist, but it's on the worker to know that that's even something they should be doing, to find the service, to sign up for it. If that could be more integrated with platforms, that's a possibility that doesn't involve policy intervention as well.
I think the three things that were hit by the others are the big ones. I think issuing 1099s is certainly going to help. I think another one is the help with expense tracking, but I think that one is maybe less of a requirement and more of a competitive advantage to get drivers or whatever gig economy participant to move over to your platform. If you're working for a ride-hailing service, because you click on your phone, they know when you're driving, they do have the ability to track a lot of your expenses, but maybe in a home sharing type arrangement or something where you're out doing tasks using tools you purchase separate from the app, it's not really possible for them to be able to help with the expense tracking. And then based on kind of the story I told and the color on that even part-time workers that we talk about, compose a large portion of the gig economy today. even for those folks, because they can have really meaningful tax impacts, at least the first year or two they work in this space, the ability to withhold is incredibly important. There are a lot of other practical implications of that certainly have to be considered, but in a tax vacuum, that would help tremendously.
And what are the implications that we see for when thinking about reform in this area for the much broader cohort of folks who are working in independent contracting, freelancing, contingent work arrangements? Are there lessons we can learn here that might be able to be applied to this broader group of folks?
So we know we have a problem of regular misreporting by those populations, right? That has been documented time and time again with GAO reports and both government and private sector data. But making more tax information more readily available via smartphone and increasing taxpayer education, of course, would address that issue. And I think that allowing for voluntary withholding agreements to encourage that is a good step in the right direction, because the trend of the platform economy might be small, but the larger trend of people working in alternative contingent arrangements, it's always been there as part of the economy. But in fact, what we now see is that it is in fact growing. And I think that normalizing alternative ways to help facilitate taxpayer compliance beyond just making sure that they get tax forms is something that would be good for the tax system as a whole.
You know, and I think about just the broader self-employed kind of, economy or set of taxpayer. First thing I think is the story you led with. The story you led with that even, some of the most advanced small businesses, they struggle with some of these issues. And then the other thing I want to touch on, going back to the last question, is the comment that was made about digital delivery of 1099s. That would be if platforms were permitted to only deliver 1099s digitally, or that they had the option to mail or deliver digitally, I think that would be a meaningful difference for taxpayers that sign up to work on a service and don't actually put the right address, or a little more transient. And so they're not always living at the same address. And so I think that would probably reduce some administrative burden of being able to do the 1099 at a lower threshold.
My last question before turning it over to the audience for their questions. We see in terms of these debates a lot of salience, a lot of attention being drawn on, as Shelley had mentioned, the work classification debate. Most recently, of course, with the passage of AB 5 in California. How should we think about the relationship between these tax issues and this broader conversation about worker classification, where folks may mix up the issues or get lost in the weeds there?
Sort of like I touched on in my earlier comments, I see it as a both and. The classification question is important. The employee relationship and the independent contractor relationship are different. They should be defined based on the relationship between the hiring entity and the worker. And there are a lot of cases of misclassification out there. We know this. That needs to be addressed, and workers who are rightfully entitled to the benefits and protections of employment need to have that. There's also a really complex tax code for independent workers, both those who are, mediated electronically and not. And that's another problem that we need to solve in order to improve the situation for working Americans.
I worked on employee misclassification and 1099 reporting issues for 6 years in the Senate, and it is very hard to make progress on misclassification issues. And I have come to the conclusion that while misclassification is important and certainly something that can and should be addressed, it should not preclude immediate action on giving taxpayers tax forms. Because misclassification could be resolved in the Supreme Court, it could be resolved at the state level, as we've seen in California just earlier this month. But at the very least, we can at least give taxpayers tax forms in the immediate future to help them, properly report their income and pay into their Social Security and address some of the issues with tax gap.
Yeah, I'll just lean in a little bit, as I love to do, into the tax side of this and put a little more context on what it would mean if particularly those service providers and drivers were classified as employees. There's a ton of considerations, right? So I'm just going to give you something to chew on from a tax perspective. We talked about quite a bit that folks that are either doing ride sharing or providing services have a tremendous amount of out-of-pocket expenses, and they deduct those to arrive at their taxable income. For W-2 employees, prior to the passage of the Tax Cuts and Jobs Act, if they had unreimbursed business expenses as an employee, one, they had to be able to itemize to be able to deduct those expenses. Two, they were only able to deduct the amount that exceeded 2% of their gross income. And three, so it limited the benefit. I guess the three would be following tax reform. I don't know why I kept counting. Sorry, I'm nervous, guys. But following the Tax Cuts and Jobs Act, no longer are unreimbursed employee business expenses deductible, even if you itemize. So what that means today is those taxpayers, unless the employer arrangement included some sort of accountable plan where they were reimbursed for their expenses or somehow else that was accounted for, that may have a meaningful impact on their tax obligations. And so it doesn't address everything, but it's just something to consider.
With that in mind, I would love to take any questions the audience has for our panel about the subject matter today. No questions at all? It's a very exciting topic. Go ahead.
Is there legislation pending that you know of, or on any house petition board dealing with these? Anything especially with the chance of passing?
So the Massachusetts and Vermont have lowered the reporting threshold to $600. So there's action there. There's a handful of other states that are looking into that. And given the success in some places, we'll see where it goes elsewhere. On the other proposals, on the withholding piece, I'm not familiar with anything that has been introduced.
So there is a Senate bill. Senator Thune has introduced S-700, which is the New Gig Act. Tom Rice in the House has the companion bill. And importantly, that bill does a great job of aligning the 1099K and the 1099 miscellaneous thresholds. And it also, so by lowering the 20,200 transaction threshold and increasing the 1099 miscellaneous threshold, which keep in mind, that $600 threshold has been in the tax code since 1953, and it's never been adjusted for inflation, right? So if you were to actually increase that and at the same time align it with the 1099K, you would get a lot of progress there. There are also some misclassification safe harbor provisions included in the Thune bill. On the House side, I worked extensively with the the House Small Business Committee to develop their version of a Small Business Owner Simplification Act, which would also align the 1099K bill, or the 1099 miscellaneous NK thresholds, but also importantly, make another tweak that's quite important for these taxpayers by updating the due dates for quarterly estimated payments. Right now, taxpayers are required to make quarterly estimated payments for the second and third quarter in the middle of the quarter. And how much sense would it make if we just had those payments be due after the quarter's close, right? So there are, the Thune bill has a companion bill in the House. The House Small Business Owners Tax Simplification Bill is a bipartisan effort led by the ranking member Shabbat and now Chair Nydia Velasquez, and has some support in the House side.
Yeah, so on the state 1099 issue, I believe that maybe a few more states, I thought even DC maybe had passed something towards the end of last year as well. But states are looking at this, and one thing that's interesting, or kind of what's interesting about what's being done, is the dollar threshold at which a 1099K is required at the state level for those that are looking at this kind of varies. It may be 600, it may be 1,000, it may be 2,500. But what does seem to be consistent is the elimination of the 200 transaction limit. So that's interesting. The other thing is, so I believe it's actually, Internal Revenue Code section 6050 cap W is where the information reporting requirement comes. And I do believe that actually it's under the Treasury regulations is where the rule exists that says, because look, it's at least arguable to think in some of these cases, or reasonable to position that there probably is, you could say this is a 1099 miscellaneous situation as well. It fits a 1099 miscellaneous as well. And I believe under that Treasury regulation that there's a rule that says if you fall under both 1099 miss and 1099K, that you use the higher K threshold and issue that form. So maybe there's a way to think about it from a regulation perspective as well. I'm thinking on the fly here, so I would want to go back that up with a little bit of research on the regs, but I think that may be an idea as well.
And I just follow up with saying that the GAO is currently doing an examination of many of these proposals, looking at these same questions.
So just a question. Shelley, you had mentioned the VITA aspect of providing more support. Are there any current constraints? I'm just not that familiar with VITA preparers being allowed to prepare certain types of returns, and are there some things that we need to be focusing on there as well?
So I signed up to do VITA this year for the first time because I wanted to see how tax reform was playing out across low-income taxpayers. And I had a great experience, and VITA is constrained by the types of returns that they can actually do, and they can't do small business income. And yet, time and again, I would have drivers come in trying to do their tax reforms, and we could only get halfway through the return because we were constrained under VITA rules by the return that we could do. And also, many, I witnessed, a number of taxpayers that didn't get any kind of 1099 and were now at the last minute, the week before taxes were due, trying to go back and reconstruct their expenses and reconstruct their earnings, and they walked back out the door, and I'm fairly confident that a number of them did not report any of that income. They just left it off and went ahead and just filed a straight 1040 with no Schedule C.
Yeah, there's sort of enough of a shell within the program that allows a second certification for volunteers to do self-employment income, but you're talking about such a small number of volunteers for such a huge number of workers that's where increased funding for the program needs to come in order to expand that to have that resource available.
Any other questions? Go ahead.
In regards to the interpretation of aggregated pay, the code and regulations seem to dictate and explain what is reported when you have an aggregated pay. How would you interpret it to an employer and employee who's in the gig economy? How would you interpret it to what is to be reported?
So I was actually having a conversation about this yesterday, and I was being pushed on the aggregated payee question, and I was looking more at the definition of a third-party settlement organization, which is the hinge that the IRS has used when they've issued their PLRs, which are the private letter rulings that they've issued for these platforms. They've gone to the IRS and said, we don't know how we're treated. Can we get a PLR that says that we are we should be using the 20,200 transaction threshold rather than just giving, rather than being treated alternatively under Code Section 6050 cap